You know what separates people who build real wealth in the United States from everyone else who just talks about it? It's not their income, it's not their inheritance, and it's definitely not luck. It's 7 habits. 7 simple, repeatable habits that quietly compound in the background while you're living your life. I'm going to break all 7 down for you today, and by the end of this video, you'll have a clear roadmap you can start using this week. Stick around for habit number 4 because that one alone shifted how I think about every dollar that comes into my account. All right, let's get into it. Habit number 1, pay yourself first, automatically. Habit number 1 sounds simple, but most people get it backwards. They earn their paycheck, pay their bills, spend what's left, and then try to save whatever's remaining. Here's the problem. There's almost never anything remaining. The fix is to flip that order entirely. You pay yourself first, before the bills, before the groceries, before anything else. The most powerful way to do this for Americans is through your employer's payroll system. If your company offers a 401k, you can have your contribution pulled before your paycheck ever hits your checking account. You never see it, so you never miss it. If you don't have access to a 401k, set up an automatic transfer from your checking account to a high-yield savings account or a Roth IRA on the same day your paycheck deposits. Even $50 or $100 a paycheck builds momentum. The habit is what matters first. The amount scales later.
Habit number 2, track your spending without obsessing over it. Most people either track every single penny in a spreadsheet and burn out in 3 weeks, or they track nothing and wonder where their paycheck disappeared. Neither works long term. What actually works is a weekly 10-minute money check-in. That's it. Once a week, Sunday evening works great. You open your banking app or a budgeting tool like YNAB or Monarch Money, both of which are popular for Americans, and you look at 3 things: what came in, what went out, and whether those numbers match your plan. You're not looking to shame yourself. You're looking for patterns. When you can see that you spent $340 on food delivery last month, that's information. And information gives you choices.
Habit number 3, build a real emergency fund. Here's a mindset shift that changed how I talk about emergency funds. Stop thinking of it as money you're not spending. Start thinking of it as buying yourself options. For Americans, the standard guidance is 3 to 6 months of expenses, but let me make that concrete. If your monthly expenses run around $3,000 to $500, you're targeting $10,500 to $21,000 in a dedicated liquid account. Not invested, not in your checking account, in a high-yield savings account. Right now, many online banks in the United States are offering 4 to 5% APY, so your safety net is at least growing while it sits there. The goal of this fund isn't to feel rich, it's to make sure that when life happens, a layoff, a medical bill, a car transmission, you don't go into debt to handle it.
Habit number 4, understand the difference between good debt and wealth-killing debt. This is the habit I mentioned at the top of the video, so stay with me here. Not all debt is the enemy. A 30-year fixed mortgage at a reasonable rate on a home you can afford in the United States is debt that can build your net worth over time, because real estate historically appreciates and your payment stays fixed while rents around you rise. A $6,000 credit card balance at 24% APR, that is wealth-killing debt. At that rate, if you make only minimum payments, you could spend years paying it off and hand the credit card company thousands of dollars in pure interest. The habit here is simple. Ruthlessly eliminate high-interest debt first. Use the avalanche method. Pay minimums on everything, then throw every extra dollar at your highest interest rate balance. Once that's gone, roll that payment into the next one. Your cash flow opens up faster than you'd expect.
Habit number 5, invest consistently, not perfectly. One of the biggest wealth-building mistakes Americans make is waiting for the right time to invest. The market is too high, there might be a recession, I'll wait until things settle down. Here's what the data says. Time in the market beats timing the market consistently across decades. The simplest version of this habit is dollar cost averaging into a low-cost index fund. That means you invest a fixed dollar amount on a fixed schedule, say $200 every 2 weeks, regardless of what the market is doing. When prices are high, you buy fewer shares. When prices are down, you buy more. Over time, your average cost per share smooths out. For Americans, your Roth IRA contribution limit in 2025 is $7,000 per year. If you're 50 or older, you get an extra $1,000 catch-up contribution. Max that out before you invest in a taxable brokerage account if you can. The tax advantages are too valuable to leave on the table.
Habit number 6, protect what you build. Here's a habit nobody talks about in wealth building videos, and it drives me crazy. You can do everything right. Save, invest, pay down debt, and one catastrophic event can wipe it out if you're not protected. I'm talking about insurance. And for Americans, this breaks down into a few non-negotiables. Health insurance is the big one. Medical debt is one of the leading causes of bankruptcy in the United States, and it's almost entirely preventable with proper coverage. If your employer offers a health plan,
use it. If you're self-employed or between jobs, compare your options on healthcare.gov. Term life insurance is the second. If anyone depends on your income, a spouse, kids, aging parents, you need a policy. A healthy 30-year-old in the U.S. can get a 20-year, $500,000 term policy for around $20 to $30 a month. That's real protection for almost nothing. An umbrella policy is the third. Once your net worth starts climbing, a personal umbrella policy, usually $1 million in coverage for about $150 to $300 a year, protects your assets from lawsuits. Most Americans with growing wealth overlook this one.
Habit number 7, raise your financial floor every year. This last habit is the one that ties everything together, and it's about intentionality. Once a year, I like to do this in January, but pick what works for you. Sit down and raise your financial floor. That means you increase your 401k contribution by at least 1%. You bump your automatic savings transfer. You review your subscriptions and cut the ones you've forgotten about. You look at your insurance covered and make sure it still fits your life. Here's why this matters specifically for Americans. Our financial landscape changes every year. IRS contribution limits adjust for inflation, Social Security rules shift, tax brackets move. What made sense for your situation last year might not be optimal this year. The habit isn't one big dramatic overhaul. It's small annual upgrades that compound, just like your investments do.
Rapid recap. Let's run through all 7 one more time so they stick. 1. Pay yourself first. Automate it so it happens before you can spend it. 2. Track your spending with a weekly 10-minute check-in. Not obsessively, just consistently. 3. Build a real emergency fund in a high-yield savings account. 3 to 6 months of expenses. 4. Kill high-interest debt aggressively and stop confusing all debt as equal. 5. Invest consistently using dollar-cost averaging. Time in the market beats trying to time it. 6. Protect what you're building, health insurance, term life, and eventually an umbrella policy. 7. Raise your financial floor every single year. Small annual upgrades compound over time. None of these habits require you to earn 6 figures. None of them require a finance degree. What they require is consistency, showing up for your money the way you show up for everything else that matters in your life. If this video helped you, do me a favor and share it with one person in your life who you think needs to hear it. That's how we grow this community. I'll see you in the next one. Take care of your money because your money takes care of you.